In this video, we'll discuss candlestick charts and how to read them in order to capture an accurate signal when you trade. Make sure you stay until the end, because we are certain that you'll gain some useful information. There are many types of charts available, but the Japanese candlestick charts are the most popular ones. That is because the candles represent the clearest way to visualize the ups and downs of a price. A candlestick chart consists of red and green candles, which provide detailed information about the price movement for a specific unit of time. But before we continue, if you find something interesting, please give this video a thumbs up, subscribe if you are new, and turn on the notifications so you never miss our uploads. We'll see you right after the intro and disclaimer. Each candlestick displays 4 key data points, which are the open, the close, the high, and the low. The colored section of a candle is called the real body, while the upper and lower extensions are known as wicks. If the body of a candlestick is small, it indicates that the candle closed near the opening price level. In other words, we can say that after a certain period, the price remains at nearly the same point. You don't need to be a scientist to read a candlestick. A green candle represents an increase in price, and a red candle represents a decrease in price. One of the best aspects of the clues provided by candlesticks is that they are visual and highly intuitive for the trader. For example, if you are analyzing a 15-minute chart, it means that every candle reflects 15 minutes of market activity. As mentioned, a green candle signals that the price moved upward during those 15 minutes, while a red one indicates that the price moved downward. At first glance, it may seem a little confusing, but we can assure you that once you become familiar with candlestick charts, you won't want to use anything else. This is because candlestick patterns often signal a potential movement in the market. These patterns can be bullish or bearish, meaning they can indicate whether the market is likely to continue its trend or reverse direction. A bullish pattern suggests that the price may rise, while a bearish pattern shows that the price could fall. Let's take a look at the most common bullish patterns. For a bullish engulfing pattern, we see a small red candle followed by a green candle that completely engulfs the red one. This formation usually appears at the bottom of a downtrend, signaling a possible reversal in the price direction. It demonstrates that buyers have taken control, pointing toward a potential trend change. The signal becomes stronger if the green candle engulfs 2 or 3 red candles. The morning star pattern is made of 3 candles. The first is red, followed by a small-bodied candle, and then a green candle that closes beyond the midpoint of the first red candle. The small-bodied star represents indecision in the market. Its presence indicates that the prevailing direction may be losing strength, either due to profit-taking or because the opposite side has gained control. For a stronger signal, this pattern should appear at the bottom of a bearish move. The hammer is a single candle pattern, identified by a short body with a long lower wick, which shows strong rejection at that level. This means the bulls stepped in with visible force, leaving only a small upper wick, or in some cases, no upper wick at all. Strictly speaking, the lower wick should be at least twice the size of the body. For more confirmation, you can wait for this pattern to be followed by a green candle, which gives a clearer indication that the price has started to reverse. The tweezer bottom pattern is formed by 2 candles of nearly equal size. The first one is red, followed by a green one. Their signal can be stronger if both candles share the same lower wick length. Similar to the hammer, you can wait for the price to form another green candle above the highest point of the tweezer bottom. This helps confirm that the price is reversing. The wicks in this pattern reveal that there was a battle between the bears and the bulls. Now let's look at the most common bearish patterns. The first one is the opposite of the bullish engulfing pattern. It is formed by a green candle followed by a red candle that completely engulfs the green one. When spotted at the top of a bullish move, it can be taken as a bearish signal, as it indicates that buyers have been overtaken by sellers, suggesting a potential reversal in price. This pattern is regarded as a bearish reversal signal that usually appears at the top of an uptrend. The next pattern is the bearish version of the morning star. It consists of 3 candles. The first one is bullish, followed by a small-bodied candle, and then a bearish candle. A stronger signal is given when the bearish candle closes below the midpoint of the first bullish candle. This pattern has the same appearance as the hammer, but in this case, it forms at the top of a bullish move. suggesting that the price might reverse. A brief breakdown of this pattern shows how the bears attempted to drive the price lower, but buyers initially prevented it from falling further. For a stronger signal, you can wait for the price to begin declining, which would confirm that sellers are becoming more dominant than buyers. Another setup is the bearish version of the tweezer bottom, known as the tweezer top. This formation occurs at the top of a bullish move. The wicks of this pattern reveal that sellers were stronger than buyers, signaling a potential shift to the downside. Let's see how you can improve your chances of getting a strong signal. Candlesticks are versatile, and they can be used on their own or combined with other technical analysis tools, such as support and resistance zones. Take a look at this example. This chart shows the price of the euro against the US dollar on a 1-hour time frame. Here, we can see that the price formed an evening star pattern. If we zoom out to identify possible zones, you'll notice how the price created a resistance area that aligns with our pattern. Once the price reaches that zone, you can anticipate either a reversal or a continuation upward without hesitation. You can never know exactly what the price will do, but you can wait for confirmation, and that confirmation may come from a candlestick pattern. In this case, the evening star signaled a possible reversal. This was just one way to increase your odds. We'll share more strategies in our upcoming videos. That's it, traders. Thanks for watching. So, if you want to learn more about our trade entry strategies, make sure to subscribe to our channel. If you enjoyed this video, please give it a thumbs up to support us in creating more videos more frequently. Also, comment below with your thoughts and let us know what topics you'd like us to cover, and I'll see you in the next episode.